So thanks everyone for joining this webinar that is hosted by the World Federation of Exchanges today. I'm your host and moderator, James Auliffe. I am a senior manager in the regulatory affairs team here at the WFE, and I'm focused mainly on market structure and technology issues. Before I get our guests to introduce themselves, allow me to do a quick plug for the WFE. The WFE has been around for over 50 years now. We are the global trade association for exchanges and clearinghouses. We are headquartered in London and represent over 250 pieces of market infrastructure, including standalone CCPs, I should add. We do lots of good stuff, but I like to think of ours like having three key main roles. And firstly, we are a source of education for our members. We aim to help improve their offerings by sharing best practice through various working groups. And for the wider community, we help to explain how markets work. Secondly, we are strong advocates for exchanges and CCPs and the value that they bring to capital markets and ultimately the economy. And we're active and engaged with policymakers all around the globe. And thirdly, we publish data and research. If you haven't seen it, there's a statistics portal on the WFE website where you'll find the definitive source for exchange traded statistics. That is available for you whether you're a member or not. And alongside that, our research team of economists all publish excellent research of critical interest to our membership and to market participants. So if you are an exchange or CCP that is not a member, then head to our website and get in touch to discuss membership. Most of you on this call are already members, so I'd encourage you to also get in touch. Make sure you're getting the most out of your membership. Feel free to drop me an email directly if you don't know where to start, but also forgive me because I'm about to go on holiday for a week. So if I don't come back to you straight away, then please, don't be too upset. Okay, plug complete. Let's turn to our guests. So I'm joined today by Alfred Boudib and Adam Bradley from the Australian Securities Exchange and Beeks, respectively. Alfred, why don't you start by introducing yourself?
Thanks, James. I am the head of sales for ASX's technical services business. Quickly, the tech services business at the ASX really facilitates market access, connectivity, hosting, and co-location services in our ASX's data center, the Australian Liquidity Center, and then connectivity outside that through our network ASX Net. That's me.
Great. Thank you, Adam.
Thanks, James. Thanks, Alfred. So good morning, good afternoon. Thanks very much for joining. Adam Bradley. I am the head of APAC for Beeks. For those that don't know, Beeks provides compute resources, analytics resources, and connectivity resources specifically designed for firms within the financial markets ecosystem. I've worked in financial markets tech for over 20 years. 10 of those were within a business in BT called Radiance. So again, financial markets, connectivity, hosting, etc. And in the spirit of transparency, I spent over 10 years with ASX as well, working with Alfred in the technical services business. So have a little bit of insight into how ASX does things and how we've ended up partnering together. Thanks, James.
Thanks, Adam. In the exchange industry, we're big fans of transparency, so I like that. Okay, then let's get right into it. Today we're going to be talking about technology. And from our point of view as WFE, we are seeing tech as an increasingly important component of an exchange and the CCP's offering. So the first question I wanted to ask the both of you was, how do you think exchanges should be viewing technology, and what are the key trends that you see in the tech space with respect to accessing markets? Which one of you wants to kick off?
Well, I'll go first, and I suspect a lot of people are probably going to say or think that we'd mention, or I might mention something about AI, because that is a highly topical subject at the moment. But for us right now and what we're seeing, I'm actually going to talk more about colo. So the conversations we're having with clients at the moment, particularly exchanges, the cohort today, many exchanges have operated their own colos or colos within a third-party data center, let's say over the last 10 to 15 years. And why this is topical is because a lot of those colos are now either reaching capacity or they've got legacy mechanical and plant infrastructure. In some cases, exchanges are even having to think about big expansions, or worst case, even having to physically relocate the co-location facility. On the flip side, there are still lots and lots of exchanges across the globe who don't operate a colo today. Over the last couple of months, I've been over in the US talking to exchanges, in Asia, in Europe, and those exchanges that don't operate colos are starting to think, do we build and operate our own colo, or do we go, excuse me, and find a third-party service provider like an Equinix, and have those organizations build and manage a colo for them. And one of the reasons that's driving that thought process is because a lot of trading firms who are well established, say in the US and Europe, are now thinking about frontier exchanges, frontier markets, to try and find new opportunities. So I think that's why colo is becoming back on the agenda for a lot of exchanges out there, either who've already got one or who don't have one at all.
Thanks, Adam.
Thanks.
Alf?
Yeah, thanks, James. Look, in terms of trends, I tend to agree with Adam. Colo is still a trend for firms for exchanges that have built colos like the ASX. What we've done over the last 10 or 12 years is really tried to build an ecosystem, and I think a lot of exchanges have tried to do that. I think that's sort of the enduring trend that we're seeing over the last few years, utilizing technologies to partner and build ecosystems and communities of interest, really with the end goal to attract trading firms because they foster liquidity, and vendors and the service provider community because they enrich that ecosystem. So for us, probably 12 years ago, we built our colo 13 years ago. Our vision for the ALC was not just something for the HFTs, just 4 walls and a matching engine inside it. Our vision was really to build a home for the Australian financial markets ecosystem by bringing in the trading community, so buy side, sell side, prop brokers, data vendors, etc., even other liquidity venues and other exchanges, focusing on the entire financial markets. The net result has been to reduce the cost and complexity, and really a simplified connectivity model. So for us, that trend continues, and we continue to look for new technologies that continue that drive to simplify connectivity models for exchanges.
Yeah, I think it's the advances in technologies which is driving more exchanges and more firms into colo today. We're seeing even more and more of a push.
Thanks, guys. The other key topic we wanted to talk about and dive into is barriers to entry. So another question to you both then, from your perspectives, what are the key barriers to entry in today's exchange markets, and how have you seen those evolve in recent years?
Yeah, I mean, once the client of an exchange or a prospective client of an exchange has decided that they want to enter that market, cost, complexity, and risk, time and time again, those show up as major hurdles for a new member or a new buy side to want to enter into a market. So a lot of exchanges, and when I was with ASX and Alfred now, trying to think of ways that you can help your prospective customers lower those barriers. So can you remove some of that complexity? Can we remove some of that friction? What can we do to try and reduce the costs? And for a firm entering a new market, that they've never traded before, there's a huge amount of risk because they invest in a vast amount of capital. Do they have the people in the region, in that country? So there's a huge amount of risk and complexity. So as exchanges, we need to be thinking about, you need to be thinking about, can you remove those barriers for those potential organizations coming into your market?
Yeah, look, Adam, I definitely couldn't agree more. And if I just to take a minute to dive deeper into an example of those barriers, like if you think of an ISV, like a global ISV, who wants to break into a new market. So let's say so this is actually a real life example. We're talking to a North American ISV today. They've won a local Australian contract, so they've got a client that they want to service in country, but they don't have a presence in Australia. So in order to service this client, they need to build out physical infrastructure down here in our colo. So under that traditional model, if you like, that firm has to procure the hardware, ship it to Australia, talk to me, rent space in our facility, rent power. They might engage a local MSP to rack, stack, and configure that infrastructure, and then manage it on an ongoing basis. And this process can take months, right? And that firm will typically front load those costs to that first client. So there's a lot of pressure then on that vendor to continue to keep winning and having success. And obviously contracts, there's a risk of the contract failing and that vendor being stuck with that upfront cost. So I just want to go through that to demonstrate the barriers, and it's not that good. It's not an optimal business model for firms like ISVs entering a new market. So that's where we see significant barriers: the procurement and build out of physical infrastructure in colo.
It's those challenges, Alfred. They're exactly the same as if you were, a new trading firm, a new quant fund. Let's say you've spun out of a major institution. You might be domiciled in Australia. You want to start trading on the US market or another exchange. You've got to invest in all of that capital, all of that infrastructure, the connectivity. You've got to take out a contract with the exchange for colo space. That might be 24, 36 months. As you say, you've got to ship the infrastructure, build it, manage it, monitor it. And at some point in the future, you're going to have to refresh that. So it's a huge outlay. And again, if you're not sure if that trading strategy is going to yield success for you in that market, it might actually make you think twice about whether you do enter that market. And particularly for, say, smaller exchanges, frontier exchanges, where the new trading firm has basically got a list of markets that they're thinking that they might enter. If you, as the exchange, can lower the barrier and demonstrate that, well, there's less cost having a go on our market, there's less risk, there's less challenge, there's less supply chain problems, there's less issues with trying to find a local vendor. If you can remove those barriers, that's actually going to move you further up the list compared to a market which is seen as more complicated and more costly to enter. So yeah, whether it's an ISV, whether it's a trading firm, whether it's a bank or a broker, if you're going new into a market, you're gonna run into those same cost, complexity, risk challenges.
It's funny, Adam, and you know this. We talk to a lot of international trading firms. We talk to them about the data, the trading access, the liquidity access. Invariably, we get to the point where we're talking to them about colo and the physical infrastructure they might need. And it's common the case that we lose them at that point because that's the barrier, right? That's the pain point that they typically can't overcome for all the reasons you mentioned. So I've been at the ASX for 15 years talking to a lot of trading firms, and I've lost count of how many we sort of lose at that point because of the risk, the complexity, and the cost.
Yeah. We were talking to an HFT earlier this week who said, which venues around the globe are your compute resources available? Because there are some markets we want to go and test, but we're not sure that our strategy is suitable for it. So they've asked us for a list, which exchanges, which colos can we essentially rent your resources. So yeah, there's definitely demand here.
Did you tell them ASX?
Of course I did. Of course I did.
So I think we've touched on it a little bit here then about sort of like the transformative potential of cloud. And I think I think that's what a lot of our members are seeing is kind of what you guys were talking about, this ability that you can just pick it up and drop it. It's a bit more flexible. You don't have to commit too much to it up front. And as Adam said, like, it's one of the key technologies that our membership is still talking about. That AI gets all of the hype and attention at the moment, Adam. I think you're right, but it's not necessarily at that point where people are finding like use cases and actual uses for it. There's still a lot of proof of concept sort of things going on.
Yeah.
So cloud seems to be transforming many industries. So how do you think it's transformed access to markets then?
Well, I think for all of us on this call, we've all got used to consuming services on demand, subscribing to services, be that Amazon Prime or be that, just other services in our lives where it's there, it's ready, it's on demand. I don't have to think about it too much or make a massive commitment, and I can turn it on and turn it off whenever I want to. So cloud computing is absolutely fantastic, right? There's some huge organizations out there that have built some massive capabilities servicing hundreds of thousands, if not millions of customers and thousands of use cases all across the globe. And the flexibility, the elasticity, all of those things about cloud are awesome, and we want to try and take advantage of them as much as possible. Typically, that flexibility and scalability is usually only available within the major hyperscalers and the CSPs. But when you get closer into our world, of exchanges and capital markets, when performance is essential, when latency is critical, in some cases data sovereignty, how good would it be if you could take those advantages of the cloud but actually have them right in the proximity of the matching engine, i.e. in the co-location hall itself? Until we were sort of doing what we're doing in Beeks, that wasn't really a reality that was available broadly. At exchanges, and rightly so, there are some huge priorities which exchanges are focused on, right? It might be upgrading a trading system, a clearing system, a settlement system. It's anything that you need to do that your regulator is making sure that you treat as an absolute priority. But at the same time, the exchange also wants to try and grow liquidity, grow their market, be more attractive for their country. So how good would it be if you can offer your customers the ability to consume compute as a service and analytics as a service in your colo or in your third-party data center where your matching engine is? And that's basically what we're doing today, to try and work with exchanges like ASX and several others to remove that friction, to lower the barriers of entry. So give that elasticity, give that OPEX budget rather than a big CapEx investment, give that predictable billing with tools and platforms which are designed specifically for you in your market.
Yeah, look, completely agree, Adam. Obviously, I think I'll just add that the distinction should be made between front and middle and back office workloads. I think for middle and back office workloads like pre-trade, post-trade risk, analytics, margin, back office are trade reconciliations, clearing and settlement. Yes, the cloud computing has been extremely transformative, and we all see the benefits of that, and it's sort of been widely documented. But I think for the front office, so trading, execution, multicast consumption, I think there's still fertile ground there for that part of the market to be transformed, and I think it's happening now with things like colo on demand. So Beeks are bringing that the great aspects of cloud now to the front office applications.
Yeah, and typically as customers of an exchange, be that sell side or an ISV or a market data vendor, your choice was do it yourself. So rent the space and the power from the exchange, buy your infrastructure, build it, manage it, monitor it yourself, have the assets sat on your books. Or you could go and find an integrator to essentially go and do all of those same things. But with Exchange Cloud, which is what we've built specifically for your market, gives the exchange the ability to continue the relationship with the prospective customer or existing customer and offer them cloud services under the exchange's brand, under the exchange's umbrella, built specifically for your client base.
Thanks, guys. So Javen in the chat has just said that their experience is that hyperscalers, the cloud hyperscalers, are looking a bit more costly, at least in the early phases. I don't think. Well, firstly, Javen, thank you for reminding me that I should have told people there is a chat function. And if you have questions for Adam and Alf, then please drop them in the chat, and I'll try to integrate them in the best way possible, as I'm attempting to do right now. But secondly, I don't think you're alone amongst the WFE membership, Javen, in your experience. I think it kind of depends on your jurisdiction sometimes, as to whether there's sufficient capacity from the hyperscalers. I know that some of them only operate in some jurisdictions only have one or two operating in their backyard, so it's not necessarily easier or cheaper, and I know that a lot of our members are still doing on-prem stuff. Adam, Alf, do you have any thoughts on Javen's point?
Yeah, look, we are not criticizing the public cloud, the major CSPs, in any way, shape, or form, right? They do an absolutely fantastic job. They've got some great products and services. We've just taken a position that we're building something specifically for this market, hence why it's called Exchange Cloud. And your customer base, because pretty much everybody that works within Beeks has come from within the financial markets, either an exchange, an institution, or a tech provider. So we live and breathe this day in, day out. We actually have some really good relationships with public cloud providers who send customers our way because they know that what they need they can't quite do. So pass it to somebody that can, still give that customer a great experience. On the flip side, we do exactly the same thing. So when we deploy an Exchange Cloud, it's not an island. We have lots of customers that say, look, I want to connect up to a public cloud provider for my storage, right? Take AWS S3. So we will build private dedicated connectivity directly to a public cloud provider so that there can be integration between both of them. That's probably what I'd say at this stage.
Look, I'll just add that, as I said earlier, we've built an ecosystem business, a point of interest community. The public cloud providers, for all the reasons I've mentioned earlier in terms of middle and back office functions, are a very popular point of interest for the financial markets community. And in our colo, we actually facilitate and make it easy for our end clients to connect to the public cloud providers. And we're kind of vendor agnostic in that sense. We want more content, whether it's public cloud providers, other exchanges, liquidity venues. We're happy to facilitate content, but we also recognize that the public cloud is not suitable for everything in all situations for all clients, and we just want to give those clients that option.
Yeah, and like we're fortunate enough to be able to work very, very closely with exchanges like ASX, that if there's an enhancement, a development that they want to see from our service offering, that we can be agile and nimble and accommodate those. Versus if you are a huge global hyperscaler, it's very difficult to bend to the will of one individual customer or even cohort of customers. That's just the difference in scale and the focus of our businesses.
Great, thanks, Adam. We've already sort of started diving a little bit more deeply into Exchange Cloud as the product, but why don't you talk us through what Exchange Cloud is and how it differs from traditional colo or managed services?
Yeah, I mean, we talk about it as if everybody knows what it is. Probably 97 people sat here or 100 people sat here going, so what actually is Exchange Cloud? So, you know, a traditional colo, as you know, we've touched on, you know, either the exchange builds the data center or has somebody else build the data center, or resides within third parties like an Equinix, as an example. And usually the exchange provides space, power, cooling, security, and then access to their platforms, be that trading, clearing, settlement, market data, etc. But then it is up to the customer to source their own hardware. It is up to the customer to build and integrate it themselves, to manage it, to monitor it. And this really goes back then to what we said at the beginning around cost, complexity, and risk. So what we're doing with Exchange Cloud, or what we've done, is designed a platform which can be augmented into the exchange's offering. It certainly does not replace traditional colo. It complements traditional colo. It's almost like an enhancement that gives the exchange more flexibility to offer to their customers. Do you want to keep doing it the traditional way? Yes. Do you want to take an Exchange Cloud, which is managed compute as a service, managed analytics, managed network as a service? It's really giving the exchange the option and give the optionality to their customers. It gives the exchange and their customers predictive invoicing and billing, so predictable costs. Exchange is built specifically for these low latency, multicast market data, PTP timing environments. So it's absolutely fit for purpose. And we provide an analytics capability on top of the infrastructure, so you can measure your latency in and out of the exchange. You can look for microbursting and gap detection in market data. You can replay the market. So really, we enable, because we provide this to the exchange, so the exchange can then provide this to their customers. I think that's a really important point to distinguish. We partner with the exchange. We white label the Exchange Cloud offering. So in the case of ASX, it's called Colo on Demand. It's actually Exchange Cloud beneath the hood, with Beeks building, managing, monitoring, patching, doing the hardware refresh. It's white labeled as Colo on Demand, and Alfred and his team at ASX are the ones who take this to market. That's a very unique proposition for a service provider. Usually service providers working in the exchange ecosystem space become a customer of the exchange and then simply go and sell to the exchange's customers. We've decided to flip that on its head, and we will work directly with the exchange, partner with them. Then that way we've both got skin in the game. We are both aligned to see that this becomes a success, and there's no walking away from it. You know, we've done the transaction, see you later. So that mean we can talk a little bit more, but that gives a high level introduction as to what those resources are.
Yeah, just because you talked about latency just a little bit there as well, there's a question in the chat. Could you tell us about low latency for cloud services impact on HFT? I think you were talking about it a little bit earlier as well, Adam. Do you want to just jump on that question?
Yeah, I mean, typically the ultra low latency firms, they usually like to buy, build, manage their own infrastructure. You know, they've got their own FPGA solutions, they've got their own algo solutions, and it's their secret sauce, it's their IP. So that's why I say Exchange Cloud complements the traditional exchange colo model. It doesn't replace it, because your ultra low latency firms are all, not always, but a lot of the time are going to want to just have, I just want space. I don't want you to provide any service to me, in the same way that a lot of them don't really want to use the public cloud if they don't have to. Whereas we did speak to a firm, an HFT, earlier this week, who said, for a market that we are not in today, we would like to go and test our strategy. We would like to go and secure PCAP data. We want to go and get that raw data from the exchange so that we can do some back testing, so that we can do some modeling before we decide we want to enter that market. So some HFTs, the ultra low latency firms, have come to us and said, we don't necessarily want to use this kind of a service via Beeks or via the exchange permanently in production, but if we want to go and test the market, that would be something we're really interested in. So I'm not sure whether that fully answers the question that came in. We would, our details will be available after this, and we can have some conversation offline if that would be helpful.
Thanks, Adam. So Alf, ASX is one of the early adopters of cloud-based infrastructure. You've taken the Exchange Cloud product and you call it Colo on Demand, like Adam just said. So what were your strategic motivations for partnering with Beeks?
Look, we found Beeks quite unique in the sense that they've specifically built an offering for exchanges, built and tailored for the demands of the financial markets community. So we felt they were uniquely positioned to offer that to us. We could have done this ourselves, right? As an exchange, obviously we've built and we manage our colo facility today. So that was considered. Thing about ASX, it's a very large organization, very multifaceted business. We operate a clearing market, the listings and markets team. On the technology side, we're undergoing quite a significant transformation, and there's a significant uplift roadmap out to maybe 2029, 2030, something like that. We're currently replacing it, as you know, our CHESS platform, our clearing and settlement platform, our equities cash market trading platform. We're currently upgrading that. There's derivatives trading platform is currently in the pipeline for upgrade. Plus, as I said, we own and operate a colo facility, and all of the the maintenance, etc., that comes with that. So there's a lot on the agenda, and where possible, we're willing and open to partner with a strategic partner that suits us perfectly. And we feel that, as Adam said, that the Exchange Cloud proposition is such a win-win in the sense that it allows us to lower the barriers for end clients and optimize our data center. Like, for example, the trend we've seen is power consumption is going up, but physical space is kind of flat.
More and more density, yeah. Yeah,
there's more. So Exchange Cloud, and what we're finding is, because clients want more power, then they need more space. They're utilizing cabinets inefficiently, in the sense that a cabinet might have 40 RUs or rack units. They might only be utilizing 10, 20% of that cabinet. Exchange Cloud allows us to densify the facility. So if a client's only using a cabinet for one server, we might say to that client, why don't you use Colo on Demand for that server, and free up that cabinet for a client that might want to take or utilize the full space. So for us, it's a better utilization of our facility and our resources, as well as essentially opening up a new product line, right? Which is infrastructure, which we've never had before. So it really is a win-win for all parties. And that's really kind of the strategic driver behind choosing Beeks.
I think, and to expand upon Alfred's point there, when Beeks build Exchange Cloud in a colo or in a data center, we enable the exchange to take compute as a service to market. And it's not just one variety of compute. We provide a range of different specifications of server. So there might be 5, 6, 7, 8 different varieties of server. So a dedicated server specifically for that individual client from the exchange. We also provision a stack of VPSs, so virtual private servers, which wouldn't necessarily be used for production trading, but they might be used to access a UAT environment. So again, when a new firm is looking to test the market and they just want to be storing some market data and running some testing, maybe you just take some VPSs on a 3-month basis, on a 6-month basis. Then when you're ready and you want to move into production, then you could take one of these bare metal or a number of these bare metal servers. Really important point to raise, which I've discussed with many exchanges over the last 12 months, is it's really important not to provide anyone an advantage over anyone else within your colo. So the way that you deliver your market access services are exactly the same way as if it was to a traditional cabinet. It's still delivered in the same way to the Exchange Cloud. So you're at no disadvantage from a latency point of view, from a networking perspective, and you're certainly not at an advantage either. That's a question that crops up all the time, because obviously, fair and equal access. There's been notable examples, over the last 10 years where that hasn't necessarily been the case. So very early on, we stressed that when we're talking to exchanges, it's still going to be delivered in a fair and equal manner. That's such an important factor.
Thanks, Alan. That's a great point. So we know that ASX loves you, but what have others been saying about you when you've been working with them? What have other exchanges been saying?
Well, I appreciate the love. Look, so the Johannesburg Stock Exchange, JSE, they were the first mover in this space. So it's like we call the product offering Exchange Cloud. That's our brand. Every exchange has rebranded it for their own market. So JSE call it Colo 2.0, and it's been in place now for, I think, 18 months, and they have over 24 different firms who are subscribing to the compute resources in their Colo. They've actually got a number of large banks who were never in Colo before. And this truly has lowered the barrier for firms to enter JSE's marketplace, because they have removed this friction. So the volume of orders being executed in Colo has increased dramatically since they released Exchange Cloud, or Colo 2.0. One of the big drivers for JSE to go down this path was their Colo was reaching capacity. And I pointed to this at the very, very beginning. People who've been operating Colo, say, for the last 5, 10, maybe 15 years, a lot of them are reaching this, we're running out of space. What are we going to do? So do you try to expand? That may or may not be an option. You might be landlocked. Do you relocate your Colo? Well, that's a huge cost and a huge interruption that you really don't want to have to do that unless you absolutely must. So JSE wanted a way that they could utilize the remaining capacity they had of space in a much more efficient manner. And that's where Alfred mentioned densifying. So when we build an Exchange Cloud, it's actually a high density stacked rack that we put into the Colo. There's multiple. So there's in an early instance, there's a compute rack and then a management or a core cabinet. In the compute rack, we're building vertically stacked, high dense servers, physical servers. Where you could squeeze in traditionally one server in one RU, we'll put in 8 in our vertically stacked. So 8 into 3 RU. So we can squeeze, as long as the exchange or the Colo can give us the power, we can squeeze in maybe up to 60 physical servers into an individual cabinet, which is way more than you would traditionally do in a 1 RU configuration. Maybe in a traditional Colo, you're going to spread that across 2 or 3 cabinets, which therefore means more of your real estate's being taken up. So we always go and build very, very dense compute resources so that the space can be used as efficiently as possible. So there's JSE. We have a relationship with NASDAQ. They've productized Exchange Cloud. They call it Proximity on Demand. We are in the deployment stages right now as we speak with BMV in Mexico. IGN have been a partner of ours for many, many years. And as I said, I've been flying around the world talking to numerous exchanges, even ones with existing Colos who, again, are reaching capacity, and a whole bunch of exchanges who are now getting into the Colo space. So, yeah, it's becoming a de facto standard for exchanges to complement their traditional Colo offering.
Thanks. That leads me very nicely into the next question to Alf here. So I think we've talked about this a little bit already where does Exchange Cloud sit in your offering? And I might try and just rope in one of the questions from Giovanni, who is from Bayes Business School. He's in the chat and asking about given that cloud computing complements direct colo from ultra low latency HFT and space is limited resource, what do exchanges tend to prioritize? Alf, do you think you can deal with all of those questions all at once? Sorry, I'm sorry. I've just said lots of words.
I'll give it a crack.
I'm sorry.
Yeah. Oh, look. Where does Exchange Cloud sit? I think as you said, we touched on it. We still see a place for that traditional colo. There's plenty of
we might have lost Alfred's network there.
Yeah.
So I think what Alfred was saying. So there's definitely continuing a space for traditional colo, and colo on demand is complementing that traditional colo offering. So I think for long term into the future, exchanges, just like ASX, will be offering both, and other future enhancements in future. To the question, which do you prioritize? As an exchange, you've got to offer fair, equal, non-discriminatory access. So I don't think you can, I'm not going to speak on behalf of ASX, but I'd say it'd be a challenge to prioritize one over the other. You've got to use the resources at your disposal to be able to address both of those requirements.
Yeah. And a lot of these questions sort of look is fair, orderly, and equal access, but also open community of interest. So we'll have anyone, James.
That's good to hear. Okay, Adam. All of our members know that it can be difficult, particularly from a regulated industry perspective, to be dealing with the parties. So how do you and Beeks ensure you're meeting the high standards that the regulators are demanding of us, and that or our members, and that market participants are demanding from them as well? How do you reach that balance?
Yeah, look, it's a great question. As I mentioned, I spent over 10 years working for an exchange. Many of the people within Beeks have either worked for an exchange, worked for a sell-side firm, worked for a global market data vendor. So we all come from your world, right? We've lived it, we've breathed it. We understand the obligations that your regulators and central banks place upon you. So it's not as though, we don't have an understanding of that. So nothing that we do is about a quick win, just to try and get something done in the short term. So we've invested heavily in security. So we are, all of the ISOs, if I think about ISO 27001, SOC 2 certified. So we run a global SOC, we run a global NOC. We actually have exchanges and customers of exchanges come and audit us. We're very, very transparent. Beeks is listed on the London Stock Exchange, so all of our financials, all of our data is out there in the public domain, so that organizations, they understand who our directors are, who our organization is, what we represent, and why we're an organization that they can trust in. Because again, we know what you face in your world on a daily basis. As Alfred was alluding to earlier, the amount of work that ASX has got with key projects which are very much under the spotlight, it's important that you don't burden your internal IT operations, security resources, compliance and risk resources unnecessarily. So we take a lot of that infrastructure burden, that connectivity burden, the management burden away. We're very transparent and we show you how we do it. We build the infrastructure in your colo or your data center. You can see it, you can touch it, you can feel it, you can have access to the firmware layer. You can bring your regulator in and say, that's where the data resides from a sovereignty perspective. So that gives everybody a great deal of comfort. From a resiliency perspective, you can see that's where DR is located. So again, if there's some kind of service interruption, it's all hugely transparent. That's how we align ourselves with the exchange, because we know where you're coming from, we know what you're facing.
So you sympathise. Great. And then Alf, looking ahead, how does ASX see infrastructure evolving in support of growth or possibly new services?
Yeah, look, I think, as I said earlier, this may be the new model, but either way, we see infrastructure moving from that fixed static deployment model to more elastic services, be it for cloud or anything else. We need to deploy services to our customers rapidly. We need to give them options to test, connect, receive data quickly and at scale. So we firmly believe that future growth is going to be enabled by this sort of hybrid capability where possible. And we, again, need to service as broad a group of clients as we can. Latency sensitive applications co-located near the exchange, and cloud-based applications can be accessed securely and reliably. So this hybrid world is here to stay, and I think services like Colo on Demand really take advantage of that.
Yeah, I think that flexibility and scale is what your customers require. You think about the global landscape today and volatility, who knows what's going to happen tomorrow. But if there's something that happens in the market that your clients want to take advantage of and tap into, the ability for them to spin up a machine, or for you to spin up a machine on their behalf, and that be available within hours for them to go and capitalize on that opportunity, that's something that simply has not traditionally been available. So the ability for your customers to dynamically, do what they need to do in a secure environment in your colo is that's a major advancement.
And I think that runs across our product suite, that sort of ethos, if you like. For example, traditionally the ASX has sort of invested heavily in a product, build it, and they'll come. For example, with our international connectivity, we light up global POPs where we see demand and make an investment there. Maybe that model changes to something that we can, partner with a firm, light up a particular exchange globally and connect down into Australia that way. So we see that sort of model of partnering with best-in-class firms and giving us that ability that agility to light up services on demand for clients. I think that's generally where we're headed.
And again, just to build on the point, although, with ASX's Colo on Demand product, our Exchange Cloud product, taking to market is a set of compute resources, analytics resources, which is a bit like a shopping list. You just pick the ones that you want and they're instantly provisioned and away you go. We are able to still build bespoke services for ASX and its customers. So as Alfred was talking about this, a global ISV, if they said, look, there's a particular type of server which we really like, or a particular type of FPGA card, well, we can build and tailor bespoke solutions. We're small enough and we're agile enough and focusing purely on this financial markets ecosystem that we can do that. We're fortunate. Whereas when you are a huge, it's almost impossible, because you can't bend to each individual use case. It's just not sustainable. It's not the commercial model. Whereas we can do this in this world, which is, again, why we've built this specifically for exchanges.
Thanks, guys. So we've got to the end of the questions that we've prepared for. So there's a couple more in the chat though, which I think we can dive into. So I think Javen's responding basically to what you were saying, Alf, about the difference between front, middle, and back office. And his question is about what's your experience of the front office, middle office platforms being able to truly leverage the elasticity of cloud? Are you seeing platform providers investing sufficiently in this regard, or are exchanges having to fund this? This is potentially a much broader question that I might steal for the technology working group, David, if that's okay. But if you have any thoughts, guys.
I mean, Alfred, I would just talk, well, not just, but again, reference your ecosystem compared to, usually people think an exchange colo is only for those who are ultra latency sensitive, or it's just for HFTs. Your colo is very different, right, Alfred, at ASX?
Oh, for sure. Like, I sort of touched on this earlier. We didn't build the facility just for HFT and low latency. We built it for the whole market, from the local Australian broking community to sell-side investment banks, for example. We, this is not commonly known, but we often firms will bring their trading stack into the ALC only, and this is common for a lot of global exchanges. But we have clients who will bring their entire data center footprints into the colo as well. So we kind of trying to be as broad as we can in our offering and not just service one particular segment of the market. I'm not quite sure that answers the question.
Well, I mean, you've already built this foundation in the colo of multiple different members of the financial markets ecosystem, be that a buy side, a sell side, your asset manager, an HFT. You've got registries in your colo. You've got retail brokers in your colo. It's not the traditional expectation of the who your next door neighbors would be. So you're now taking compute as a service to them, which again is not what's usually expected within an exchange colo. So I think you're already well on the right path to being able to add the value back to the broader front, middle, and back office user base.
Another question in the chat here. We're not going to get away without talking about AI, Adam. How will AI impact in the colo? Any thoughts?
Well, certainly from a Beeks perspective, we've partnered with ASX to be able to offer analytics as a service. So this would be monitoring infrastructure at the wire level. So as I said, measuring or monitoring latency, looking for gap detection, anomalies, microbursts. So we have added AI into our latency monitoring capability to basically start to predict where you are likely to then see one of these issues, one of these incidents occurring before it actually occurs, based on the data that we have been storing, and then based on the inference and the learning of the platform itself, to give you a head start before the issue actually arises. Everybody's doing something in AI these days, but not necessarily having a problem to solve. Whereas we know that if you have got a gap in your market data, or you have got a latency spike in your network, where is it happening, or where is it likely to happen, and now can I then go and do something about it predictively, proactively, before the incident actually hits my books. So I think I can't remember who asked the question, but we call this edge intelligence, and again, it's going to be available within ASX's colo. So would love to be able to share more information for anybody that's interested to learn more.
Yeah, great. It's Eduardo, I think it's from B3. So please reach out to Adam afterwards, Eduardo.
Okay, all right, can do.
There is another question. It's quite a long one, so I'm going to try and summarize what I think the question is. And I think the question is kind of a buy versus build. How do you balance that sort of issue? But it's also about serving both your own markets and also delivering that trading system to other exchanges. So it's kind of buy versus build versus selling what you've built as well, I suppose.
Do you want to go first, Alfred?
Yeah, look, maybe I'll leave that one for you, Adam.
Well, look, I mean, again, you can always continue to buy yourself, buy it and build it yourself. I'm pretty sure we're all old enough, and we're all living through the pandemic in our professional life in financial markets. We know what happened to the supply chain. and there's still ripple effects and repercussions on the delays within that supply chain. So if you did want to go into, a colo now, and as I say, I've been on the road, and in some countries I'm being told by customers of exchanges, it could be like a 12-month lead time before cabinets are provisioned, before I can get my infrastructure and actually get that built. Now, can you afford to wait that long? That's a risk in that 12-month period. So if you could go to the exchange, or if your customers could come to you and say, hey, look, I want to do the traditional colo model of buying my own infrastructure and you provisioning the racks for me, but in the short term, can I rent some of your bare metal compute? Can I get access to the UAT environment? Can I get access to your PCAP data? Can I start doing my back testing and modeling? Do all of that in parallel whilst you're waiting for your network appliances, whilst you're waiting for your servers to be delivered, whilst you're building a relationship with a local integrator, so that you can still have a head start and capitalize on that opportunity. So it's definitely, I don't think it's a case of doing one or the other. I think it's basically having the flexibility and the choice to do both. Really, I think that's what we all want as consumers, is choice. So as an exchange, I think it's great if you've got the ability to give your customers that choice when they're thinking about doing new business with you or expanding their business with you. I think I might have answered about a fifth of the question there and just gone off on a tangent. Apologies.
So there's one. We're running out of time very rapidly. So one last question from Michael: does the colo cloud option have a latency difference compared to traditional colo? I think that's for you, Adam.
Well, I mean, look, it's down to each and every exchange. As I stressed, and Alfred will can build on this point. The connectivity from the matching engine from the market, or wherever the exchange's DMARC is, to the exchange cloud or to the colo on demand cabinet, it's delivered in exactly the same way. So from a network latency perspective, from a market access perspective, the number of hops, it's exactly the same, whether you've got your own cabinet and you've built your own hardware and you're managing it, versus whether you're taking a colo on demand server or servers from ASX. Alfred, do you want to?
Yeah, look, that's exactly right. The way we're delivering our raw data feeds, for example, our trading connections, ouch, none of that is changing. It lands and can be connected directly into colo on demand, but none of that is changing. Clients have access to the same services. The only thing that's changing is they can connect those directly into their colo on demand presence and forego the need to have a cabinet. But yeah, the cloud option or the colo on demand option will not have a latency difference compared to being in your own cabinet.
Yeah, I think, if you went down sort of into that rack elevation of the actual resources, there was a data center provider out there who was providing bare metal as a service, but the infrastructure they were using was not designed specifically for this market. So we're deploying for ASX low latency Arista switches, solar flare cards, all of the same infrastructure that you would go or your customers would go and buy, build, monitor themselves. It's the same stack that we actually do, because we know that it's designed specifically for low latency trading environments. It's for high throughput data. It handles multicast and PTP natively, which is exactly what you need when you're inside a colo. So there's no disadvantage other than So it's I would say you're on a level playing field, but you don't have to refresh the hardware. You don't have to sign up to a long contract term. You don't have to wait for kit to be delivered, provisioned, and you don't have to manage it yourself. The exchange is doing that for you, or we're doing it in partnership with the exchange.
Right. We are now 1 minute over schedule, which is fine for me because this is the start of my working day, but it's the end of your working days. But have you guys got anything, like any final comments you'd like to make?
Alfred?
No, none from me. Thanks, James, for organising this. It's always great, and Adam knows this. It's great to talk to other exchanges, especially ones interested in this subject. I always like to hear how other exchanges do colo and connectivity businesses, and it's always refreshing. And it's always good to meet other people from other exchanges. So the guest list is quite varied and interesting. So I might be adding a few of the guests on LinkedIn.
I'd echo your sentiments. And as I said to the audience, I used to work for an exchange. I spent 10 years running a P&L, running a colo and connectivity business. So I've lived and breathed your world. So we can have a conversation. I'm under no illusions that something's going to happen quickly. We're all part of a similar kind of ecosystem. If we put our minds together, we share ideas, it's only going to benefit all of us. And all the exchanges, you're all sharing mutual customers as well. So if anybody afterwards wants to connect on LinkedIn, I think on the WFE website, when the replay goes up, our contact details will be there. More than happy to chat, share ideas. There's, again, like I say, no expectation that we have to do something. Let's just have a chat.
Great, thanks guys. As Adam says, we're going to put this up on our website, so you'll be able to watch it back, because we know that's what you want to do, because it's such an excellent chat. So we'll be available there if you want to find our contact details, or Adam's contact details, or Al's contact details. So thank you all for joining the chat, and I hope to see you soon.
Thanks, James.
Thanks, James.
Cheers, everyone. Bye, Alf.